Good morning, everybody, or afternoon, depending on which part of the country you're in. We're just going to give people a minute to roll in, um, and we will get started. My name is Martin. I'm the founder and CEO of VetBooks, and I've got with me today Dr. Joy Furman. Joy is a longtime collaborator and friend of mine, who's a bit of a unicorn in the industry, a DVM, a CPA, an MBA. I mean, are there any degrees you don't have, Joy?
The JD.
Yeah, that's right.
I keep thinking about working on that one.
That would bat for the cycle. And then we've got Danielle, who supports us with some of our marketing and client initiatives, working the Q&A. This is a an interesting session for us because a couple of weeks back we did the power of the P&L, which is sort of a broad brush walkthrough of what the P&L is. And the feedback that came back almost instantly was, okay, super great, really interesting. But what I'd love to do is actually dissect and see an actual P&L. And I'm kind of nerdy enough that I read P&Ls for fun. And I'll often call up Joy and say like, hey, let's noodle this one over. And so we are fairly unscripted. We're organized, but fairly unscripted this morning. And we had a couple of volunteers step up and offer up P&Ls. In fact, we had more volunteers step up and offer P&Ls for analysis than we have time for today. And so I just want to lay a little bit of groundwork before we jump in and look at this one practice in depth and another practice with a little less depth. So, new slide. This reflects my thinking and realization, and frankly, the almost the reason for being of VetBooks, which is that financial controls, like really good financial controls, are the fundamental building block for all other decisions in the practice. When you've got control of your finances, you can do better supplier selection and supplier and product selection. You can engage operational consultants like Joy. You can finesse your banking relationship and maximize the value out of that. You can get insurance advice. You can get better advice from your tax planning and tax compliance with your CPA. You can do wealth and estate planning. You can do valuation. All of these things are maximized. You get better value, better return, and better outcomes when you've got your books tightly under control. And I think you'll see today an example of a practice that has their books under control and it allows them to make decisions. For those of you who attended the webinar a few weeks ago, you'll recall that I presented this framework. It's often referred to as the rule of 20. I call it the 5 buckets. And the model is that revenue represents 100% of the dollars coming into the practice, and dollars going out of the practice go out in one of 5 buckets. COGS, DVM labor, other labor, OPEX, and profit. And what you'll see today is a practice. Well, what we'll see today is that if your COGS are higher than 20%, that money's got to come from somewhere, which means you have less money for labor, OPEX, or profit. If your labor is higher than 40%, right, DVM labor plus other labor, higher than 40%, that money has got to come from somewhere. Either you've got to spend less in OpEx and COGS, or you make less profit. This is a zero-sum game. There's only 100% of revenue to allocate, and these are the only places that it gets allocated to. And so this is actually why I fundamentally love the P&L, because it's where the action happens. It can be gamified if you know the numbers and you've got the granularity to view it. I want to encourage people, if they have questions along the way, to put them in the chat or in the Q&A box. Danielle is monitoring those. And I think what we're going to do is we're going to start. I'm going to switch my share. I've got, again, this is a less formal presentation because it's more workshop-y. And I'm going to open up our real live animal hospital P&L. And I'm going to start with this overview. So here we're looking at real live animal hospital, who, and by the way, real live animal hospital, I haven't looked at our participant list, but our real live animal hospital may actually be, for anonymity's sake, we're not naming the practice, but the real live animal hospital may actually be in the participants, among our participants today. Let's take a quick look. Are you here? No, not here. So here we have a real live animal hospital, and this is the P&L, and it starts with income. So this is for the 9 months, January to September 30th. So you're looking at 9 months, and you can look at a P&L in any time frame you want, right? You can look at it monthly, you can look at it for a quarter, you can look at it for half a year, you can look at it for a rolling 12 months, for a full year. We happen to be looking at it for 9 months, which means you have to make a little bit of inference for what the rest of the year looks like. So here we're starting, here we're looking at 3.7 million to the end of 9 months, which is approximately, Joy, what did we do the math on that? About 1.2 per quarter, right?
Correct.
So we would anticipate that this practice, assuming, there's some fluctuation, I'm sure, would end up at about 5 million for a year. So it's a $5 million in revenue, top line revenue practice. I can share with you that the practice is in California and had 4 DVMs until September of this year, when they're now back up to 5 DVMs. So the first thing we did, Joy, I guess, is just take a quick look at the 5 buckets, right? Or I guess in some ways it's 4 buckets, because labor is a little hard to break out. Labor takes a little more analysis to do DVM labor versus other labor. The sub-analysis that you can do that we did not do here, but one could do on their own time. And COGS, so cost of goods sold, is sitting at 22%, so a little higher than the 20%. And expenses, total for expenses, is 72.3%. And profit is 5.6%. So that's sort of quick, high level, but of course there's a lot more to the story. And so here is the breakdown with revenue and OpEx detailed out. And Joy, you want to walk us through what happens when we get here?
Yeah, I sure do, but I'd like to just circle back to the revenue really quickly, if that's okay, if you want to pull that number back up. Now,
Absolutely.
obviously, there's a lot of information within that revenue line that we don't get in our P&L. So your number of transactions, your ACT, all of that is kept in the PIMS versus in the financial accounting records. That being said, in general, we want to see each doctor producing somewhere in the region of $1 to $1.2 million per year. So that translates to roughly $100,000 per month each. So at $400,000 of revenue for a four-doctor practice, this practice is spot on in what they should be generating as compared to other practices in the industry.
That's down here at total for income on line 62. And you would expect that now with 5 doctors, you would see an uptick in that last
It
quarter,
should
right?
go up to 500,000 or roughly around 500,000.
Is there some geographic variation in that too?
Yes, absolutely. Like I'm based in Arizona and I can tell you the slowest months of the year are the hot summer months. So you're definitely not going to see significant revenue generation there. And every area has their seasonality for sure. But if we look at the numbers on kind of an annual basis across the country, we're probably still wanting to see around 1 to 1.2 million per doctor.
So 8.
Sorry to jump in here. Two things.
Thanks, Danny.
One is we're getting some reports that people are struggling to see the numbers on the screen. So I just want to encourage everybody to make sure that your Zoom screen is in full view, so you can enlarge your screen, and then see if Martin can zoom in a bit as well. And then the other thing is we do have a question here. Is there a benefit to tracking revenue at that detail?
Oh, yeah.
Absolutely 100%. Do you want to grab it, Martin, or should
No,
I
you
jump
first.
in?
You
Okay.
and I can both be emphatic
Yeah,
about the importance of the detail.
so many reasons why you want to track your revenue by category. So first of all, you want to be very clear about what revenue you're generating from services versus sale of products. And ideally, you want to be striving to be generating roughly 3/4 of your revenue from services as compared to what you are generating from products, because those are much higher margin revenue generators. The other thing that's important, and I know Martin will jump into this a little bit later, is being able to track your gross margin per category. So how much profit are you really making on vaccines? How much profit are you making on your in-house lab versus your reference lab services? Those numbers are really important and give you great insight into where you can raise prices and how you should be pricing your services.
I am trying
Great
to
question.
freeze. Yeah, super important question. And fundamentally comes down to, I mean, I read the question as, so what you're looking at here is a practice, happens to be a practice that is a VetBooks client, where we've rigorously implemented the VMG AHA chart of accounts. And so when I hear that question is, what I hear the subtext of that question is the VMG AHA chart of accounts a worthwhile initiative endeavor? And for the reasons that Joy pointed out, yes, absolutely it is. You will notice my cursor jumping around a little bit. I have a tremor which makes work in the computer a little difficult. But I'm trying to freeze. Well, can't freeze the pane. So I will just, I've made it a bit bigger, and we'll just toggle back and forth here a little bit. Maybe what I can do is hide 3 columns so that we can see the totals. So I've hidden the first quarter. If we need to unhide it, we certainly can. Okay, Joy, why don't we take a look at the 5 buckets? So revenue, we know down here at line 62 is 3.7 million for this time frame. That represents 100% of what we're allocating. COGS, I have completely collapsed COGS at 22%. There's a lot of detail that goes behind COGS. And I'll show that in just a minute, but do you want to talk a little bit about 22% and how you feel about that?
Sure. So, obviously the numbers really vary depending on type of practice. So, what I mean by that is general practice versus emergency versus specialty hospital. For the most part, for general practices, we like to see COGS probably in the region of 22 to 25%. So, for this practice, I don't know that there's significant room to decrease the COGS. In today's market, we're seeing significant inflation. Drug prices are going up every single week that you order them. So I don't know that this practice could spend a lot of, it could significantly impact the COGS that they are generating. That being said, and as Martin pointed out, there's a lot of detail that should go into your cost of goods sold. And yes, it is important to track this information. Again, the biggest reason being so that you can see what your profitability is per revenue generator. So what are your vaccines? What is your profit on vaccines? What is your profit on labs? It also helps guide you to see where you're spending your most money and help you understand, is that the area that you're generating your most revenues? So a lot of really good information that's worthwhile delving into the details, especially if your COGS is out of balance and is higher than 25%.
Question
Two
about
comments.
COGS. Does that
Go ahead.
include labor?
No,
No.
cost of goods sold does not include labor. Labor is its own bucket.
There is a nerdy debate about whether specialists who come in to provide services on a 1099 basis should be included in COGS. But by and large, no, all labor is in the OPEX bucket. So just so that we can see how the granularity with which COGS, I'm going to blow this open. I'm going to press this little plus sign here. And you can see that COGS breaks down into a whole lot of detail. So all of these cost detail are, and remember from the Power of the P&L presentation, COGS is your variable costs. It's the costs that are required to provide the service. And so you can see here, there's categories for professional services, there's pharmacy cost subcategories, there's dietary cost subcategories, laboratory, imaging, ancillary products. There's a whole lot of detail that goes into COGS. And here I am going to roll it back up again. Okay. Okay. So 22%, Joy. I'm sitting here saying like rule of 20, 5 buckets, everything, we should strive to get everything at 20%. And you're telling people it's okay to be at 22 to 25. Is that just the reality, the painful reality of the market today?
Absolutely, Martin. You're 100% correct. You can absolutely strive to go for 20%. And for practices like emergency practices, for example, that aren't carrying, high cost, low margin items like preventatives and food, we can certainly see COGS come down to even 15%, 15 to 18. So I don't think it's unrealistic to set a expectation or a goal for 20%. But yes, you're exactly right. In today's environment, the inflation on medical drugs and supplies is so significant that it's been some time now since I've seen a practice get honestly even as low as this at 22%.
Okay, so this real live animal hospital seems to have COGS more or less under control. And even if you were going to try and drive COGS down to that 20%, you're going to have a tough, tough, tough go. It's going to take a little bit of work to strip out that and let that last squeeze out that last 2%. So that leaves then so on the math, right? You've got 100% of revenue, 22% is COGS, so that leaves you 78%. So another way to frame this problem, to frame the thinking is, for every dollar that you earn, 22 cents go to COGS. 78 cents are then left for operating expenses, which include labor and all other expenses, and profit. So how are we going to allocate the rest of our 78 cents? What I've done here is I've expanded the labor accounts. And so you'll see here, they start with the compensation accounts, which are the heaviest of the accounts, but also includes everything else that it takes to have an employee on staff: payroll taxes, fringe benefits, and other costs, which sometimes include uniforms, training, those kinds of things as well. And we see here on line 159 that labor is 54.6%. So remember the 5 buckets. Combined labor should be 40%, 20%. Strive for 20% DVM labor, including the allocation of benefits and taxes for DVM labor, and 20% for a non-DVM labor, or all other labor, again, including benefits and taxes. It's a little hard to split out benefits and taxes. You could do a prorated version of benefits and taxes to calculate that, to figure out how to allocate this 54% in those 2 sub buckets. But when you lump them together, you've got 40% allocated for labor, and here we are at 54.6. This is a problem. What do you think, Joy?
Well, I was going to say, is it a problem?
Well, you're right. It's
Labor,
not fair. It's fair to say it's a problem.
labor is, the one thing that is highly variable. It's market dependent. So obviously we know this practice is in California. In areas like California, the East Coast, we're going to have higher wage rates than we would in, say, rural Kansas, for example. In addition to that, larger practices are probably more inclined, in some cases even legally required, to offer benefits. So their labor costs are going to be higher than a 1 doctor, 5 staff practice in a smaller town. The other thing to consider is owner's compensation. So in most private practices, they are held as S corps. That's the legal entity. And the owner or owners are working with their tax providers to maximize their tax benefit or minimize tax payments. And there's various structures that can come into play in terms of how much of the owner's salary goes into payroll and how much of it is distributed as dividends or distributions of profit. So all of those factors come into play. So it's very difficult to say, when comparing one practice to another, what is truly an appropriate standard for labor. So yes, while we can acknowledge that striving for that 40% mark is ideal, we are certainly going to see variability from practice to practice.
Well, and this would feel like a really good time to take a detour and talk about benchmarking for just a minute, because ironically, given my pedigree in the industry, I'm sort of not critical, but I've got a new view of benchmarks in general, which is that the best person to benchmark against is yourself, right? The reason to do the work that Joy and I are talking about today is to really know your numbers and come up with a formula that makes sense for you, right? And so if 54.6% labor and the resulting profitability down at the bottom here, we'll see a 5.6%. We saw already on the overview a 5.6%. If that works for you, and in fact, I spoke to the owner of this practice, and they're not happy at 5.6%, but they also don't feel like they need 15%. The business is owned debt-free. It's they own the real estate and it's generating rent. They pull a good salary. So all of the sort of personal factors around what makes a good business for you is what you need to be thinking about. So Joy, you're absolutely right to say, 54.6% may not be a problem at all. It may be bang on strategy, might be 100% what they're trying to do. And I really am big on this idea of know your numbers and make a plan, make a profitability plan that's right for you. The other thing I'll say, which people who have seen or who have attended our webinars or seen me speak before, is it's way more fun to work in a business that's making money than one that's not making money. And it sounds trite, but the pressure that comes from, knowing that you're losing money every day is intense and not the good kind of intensity. Okay, Joy, we've got 22% COGS, 54.6% labor. By my math, that's 76.6%, which leaves 17.8% for other expenses. So another way to think about this is for every dollar earned, 22 cents goes to COGS, 56.4 cents goes to labor. That leaves 17.8, that leaves 17.8 plus 5.4 is 24.2 left over to allocate. And in this practice, 17.8% is allocated to other expenses, which is like pretty under control, I think.
I would tend to agree with you. I mean, for me, I prefer to break out that OPEX bucket into facilities costs and then administrative costs. And you have that detail here.
We do.
Now, again, facilities costs is something that, for the most part, is not really in anyone's control. Your rent is what your rent is, your mortgage. Like no one really has control over what they're paying in electricity and other utilities. So that's the one area that's really more fixed than anything else. One thing to consider is that number really varies depending on how the real estate is held. So, are you renting in a shopping center? Or are you renting, but the owner has a joint entity that owns that real estate and is setting the rent? Or is this like truly just the mortgage that you're paying on the rent or on the property? So that number is somewhat can potentially be manipulated. Generally speaking, I like to see facilities expenses around 8 to 10%. Again, it's going to be very market dependent. Obviously, your facility costs in California are going to far outweigh some other areas. So although this practice is operating at about 11% of facility expenses, that might be reasonable for the market that they're in.
And you see that 11% down here on line 192, which is the sum total of the lines from 160 to 192, right? So maintenance, service contracts, repairs, utilities, telephone services, etc.
Correct.
Should we have a quick conversation about rent? Which is, I went back to this practice. I went back to this practice's P&L of 3 years ago, and rent was held at the same $25,000. And when we spoke with when we spoke with the owner in advance of this, I said, "So is that market rent?" And they said, "We're not sure if that's really market rent, but it's the rent that we've charged ourselves." And so there may be some opportunity here to, I mean, you have to charge yourself. Now putting on your CPA hat, Joy, uh, you have to charge yourself market rent, right? You can't charge yourself below market rent.
It depends. I mean, there certainly is, just like with owner's compensation, there is a threshold that it needs to be a reasonable amount of rent. That being said, there's a lot of debate and discussion about whether or not we should be charging ourselves market rent and making the practice numbers look more realistic versus below market rent. And again, that's going to be a discussion with your tax provider as to how you want to pay tax on the income and who's the actual owner of the real estate. So there's a lot of factors at play when you decide to set the rent. What I don't like to see, though, is significantly lower than market rent, because that makes your practice look unrealistically profitable, and you
That's right.
sitting there thinking that you're doing incredibly well. But in reality, if someone were to come in and buy the practice and would have to pay a market related rent, this practice could potentially be in a loss position.
Danielle?
Yes, we've got some questions rolling in here. Joy,
Sure.
skipping back to when you were discussing about revenue that the doctor should bring in, this person just wants clarification around that 1 to 1.2 million per doctor. Would you exclude revenue from non-medical services like boarding and grooming in that?
Yes, that's just generation of the actual doctor production.
Okay. Next question here is, this practice has mobile sonographers and a mobile surgeon that comes in for orthopedics. Does that fall under COGS or OpEx?
I'll let you take that one, Martin.
Oh, thanks, hot potato. Um, so it's a bit of a divisive issue, and I, just to be perfectly clear, I am not a bookkeeper. I just love the outcome of great bookkeeping. So I believe that we put it into to OpEx, but there are others that would put it into COGS, because but for um, the revenue that's being generated for the services, you wouldn't have hired those. You wouldn't have hired the revenue being generated. Uh, requires that you hire this variable cost to come into your business for that. So there's an argument that could be made to put it into COGS. Uh, uh, we generally put it into OpEx.
If OpEx should be at the 20% bucket and facilities should be at the 8 to 10%, does that leave admin costs at 10 to 12%?
Yes, exactly correct.
Okay.
Math. It's a zero sum game. You
Oh,
only have $1 to allocate. It's great. It's the
uh,
best. It's just the best part about this thing, that the whole thing is magic when you realize that it's a zero sum game and you only have $1 to allocate, 100% to allocate.
a couple more here is, one is, what is in the service contracts that fall under the maintenance?
Ooh,
Well, I can't speak for this practice specifically, and it's going to be, varied practice by practice, but it could be anything from maintenance of your medical equipment to IT costs included in there. Um, I, I've seen it handled a number of different ways. What's
I'm
your
going to
perspective, Martin?
I'm going to jump out of this presentation for just a second and share my screen and point people to the AHA VMG chart of accounts, which you can Google. If you just put into Google AHA VMG chart of accounts and you go to the chart of accounts field definitions, which is here. This is account 7530. So I type in 7530 service contracts. So service contracts. Service contracts associated with maintaining the practice facilities, grounds, and equipment should be included here, such as security alarm contracts, landscaping, snow removal, et cetera, et cetera. So what I've just shown you is anytime you have a question, this is another great reason to use the VMG AHA chart of accounts. Anytime you've got a question about what goes into it, there's been a lot of work and thought that's gone into the field definitions, and you can find them readily accessible at the AHA, if you just Google AHA VMG chart of accounts.
Looks
I will
like
also note, go ahead.
the hospital that you are reviewing is responding back saying that's a managed service provider with an IT company, and it's a monthly fee for handling general IT stuff. So kind of clarifies that as well for them.
Thank you, Anonymous.
Thank you.
And then we have more. Oh, sorry. Go ahead, Martin.
I just wanted to make one more comment about the AHA VMG chart of accounts, which is by the end of this, I'm told as of 5 minutes before this call that by the end of this year, there are changes coming to the AHA VMG chart of accounts to renew and refresh some of it. This was hard negotiated, nerdy hours and hours of intense discussion, some of which was controversial, some of which was non-controversial, like Yellow Pages no longer needs its own category in the AHA VMG chart of accounts. So look for changes at the end of the year. Sorry, Danielle.
Oh, no worries. On that revenue benchmark of 1 million per, is that for hospitals only?
Sorry, could you repeat the question?
It says on the revenue benchmark per FTE of 1 million, is that for hospitals only?
For hospitals only, as opposed to,
I don't know, maybe
I
mobile.
don't know that I necessarily understand the question.
Can you clarify if we have not answered that question already through the Q&A, hopefully? And last year is the discussion on labor percentages. Was it too much at that percentage for this clinic?
If I recall, I looked at 2 years ago, and it's held steady pretty close. Maybe Anonymous can confirm, but it's held pretty firm at the well above 40% and into the 50s, late 40s, early 50s.
Clarification on that question about revenue benchmark. She meant is, does it apply to all types of veterinary practices? At that point?
Generally speaking, yes. That being said, we would probably see higher revenue generation than that in specialty practices for sure.
And Joy, just a hypothesis here. So I've seen one doctor practices that produce $700,000 to $800,000, and I've seen one doctor practices that produce $1.5 million and more. The difference would seem to be one of two things. Number one, how leveraged, so this is a labor leverage question mark, right? How leveraged the doctor is, right? One doctor surrounds themselves with 6 techs and let the techs work at the maximum of their capability. Those practices knock it out of the park. Whereas other doctors, other practices that may not be leveraged as much, don't earn as much. And the other thing is not just delegation of veterinary service delivery, but also delegation of other duties as assigned. So the one that I'm most familiar with is I still meet, single docs who are doing their own bookkeeping. And I'm like, well, you could do 3 dentals instead of bookkeeping.
Yeah, you're exactly right. Definitely leveraging the staff is a huge factor. Also, are there other revenue sources like boarding and grooming? Some of those will come into play. And then there's, as I said, that revenue number's made up of visits and average transaction costs. So what is the pricing that your market can bear? So, yes, some practices may be a $700,000 or $800,000 single doctor practice, but maybe that's the pricing that is appropriate in that market.
Okay, I want to see if we can do 3 things left with the 13 minutes that would leave us 5 minutes towards the end. The 3 things are, I want to talk about the summary of these 5 buckets for this practice. I'd like to look at the gross profit percentage and talk a bit about how do you get that 5.6% that's left for profit? How do we get that up to closer to 8 or 10%? And then hopefully time will allow, we've got another P&L. It's a PDF only from a practice that doesn't use the AHA BMG chart of accounts, that we can look at the same 5 buckets, but it's a really good example of sort of some of the limitations of being able to manage your practice when you don't have all of the detail that we've got here. So that's sort of my plan. I'll see if we can pull it off. Let's just look quickly at the summary. So I'm back here. Here's the summary screen. So this is for the practice we've just been looking at: 100% revenue, 22% COGS, 54.6% labor. There's probably some work that can be done to understand the difference between DVM labor and other labor. Maybe an opportunity to talk about labor leverage there too, right? And understand, are techs being used enough? Do you have enough techs? Could you use, more techs, less docs? And then 17.8% OPEX, leaving 5.6% profit. So on 3.7 million, right? A way to think about it is every 1% of profit is $37,000. And so what we're looking for is, about $150,000, right? $150,000 of additional profit to get us to that 10% mark, which is an artificial number that I've just made up, right? It's like we spoke with Anonymous. Anonymous said, the owner of this real life practice said, there's a lot of other revenue streams. There's no debt in the business. The rent is good. We earn well. We draw well. But yes, it would be nice to get that profit up. I don't need 20% on a $5 million business. I don't need the business to throw $1 million. But if it threw, $500,000 a year at 10%, that would be great. And so, Joy, where do we find that money?
Well, one of the places to think about, I know we said we cannot really reduce COGS in this practice, that 22% is a good spot. But I would delve into the details of, what is the profitability on, for example, reference labs? Is there room to grow, to increase the reference lab pricing, and drop that additional revenue down to the bottom line? So one way we can find that additional income or additional profitability is by growing revenue. The other place that I tend to find a lot of lost revenue is in mischarges. So doing all of those, going back to the drawing board, doing all of those lab audits, making sure that every single client or every single reference lab test that was sent out was charged, was appropriately charged. These are the ways that we can capture that lost income, grow your revenue without even raising your prices. And, I've seen significant amounts of additional income come to practices that are doing the work to make sure that they aren't missing those charges. And then there's, monitoring profitability and markups on a regular basis. Some practice management systems will allow you to adjust your pricing automatically when the price of the cost of the product increases. Others, you just set a price for that product. So regardless of any variability in what you're paying, your markup is going to get adjusted instead of the actual charge to the client getting adjusted. So those are some of the areas that we can really squeeze out some additional profitability.
So,
Go ahead,
so that
Mark.
I've got a particular bee in my bonnet about discounts. Now at this practice, they're not. So another thing that I love about the VMG AHA chart of accounts is there's an account for everything, including discounts here at line 51 in a GL code 5905. And this practice for the 9 months ending September 30th has given away $75,000. Now here again, this is about what's your strategy and having the intellectual honesty to say, and keeping track of your discounts to say, I am okay with having given away $75,000 in discounts. I will note that if you go to the extreme and you say, we do not discount under any circumstances whatsoever, 0 discounts, that assuming that business remains the same without the discounts, that $75,000 would drop straight to the bottom line, and your operating profit would be 7.6%, not 5.6%, and you'd be a lot closer to that, a magical, 10%, 12% kind of number. But again, I've spoken with the owner of this practice, and they are open to looking at discounts, but also sort of acknowledge that this is a number that makes sense to them.
Martin, do you know what's included in returns there?
I do not, but maybe not. Yes, this is actually an overstatement that gets clarified in October, November, I believe. Maybe Anonymous can. It was a communication breakdown that gets fixed in November, December, I believe. Sorry, October, November's books. Anonymous can clarify that for us. Joy, you hinted at understanding the gross profit. I want to share this other screen, and apologies again to attendees for all the jumping around, but we brought a lot of show and tell for today's session. So this is a gross profit analysis for the same real live animal practice and this is, again, yet another reason why the VMG AHA chart of accounts makes sense, because for every, and I'm just going to scroll up to the top here just to give you a sense, because for every revenue category, there is a corresponding cost category. And when you know the revenue of a thing and you know the cost of that thing, you can get the gross margin of that thing. So you can then start to look at what are your gross margins for the vaccine portfolio, for fluid therapy, for diagnostics, for mortuary, up and down the VMG AHA chart of accounts. Every one of your cost centers, your revenue centers has a corresponding cost. And this is a place where you can start to look at, are you making the profits, that the gross profit, right? The revenue minus COGS, that then leaves the residual of that is then left for your operating expenses and profit. So I know that I'm using the word profit twice in that sentence, gross profit and net profit, let's call it, or net operating profit. Again, you'll recall from the power of the P&L that profit has many names. And so, you know, you can see here FDA flea tick is, you know, running pretty variably here, 37%, as low as 26% one month to 60% another month. Lab costs, it's a great place to view in-house versus ref lab revenue and costs. And again, this is where you can look at your pricing and your supplier contracts to make sure that you're maximizing profitability in each of these sections. Okay, I think we have spoken lots about the real live animal hospital. Danielle, if there are no other questions, I'm going to use the last 3 minutes to share yet another vet practice who was kind enough to submit their financials. Joy, you haven't seen this, so this is a surprise. This is a totally different practice. This is in Georgia. And again, I only had PDF, so did the 5 buckets, again, to the best of our ability, right? So this is a practice that is not using the VMG AHA chart of accounts. The cost of goods sold are high at 28.3%. Total labor is 44%, and other expenses are 16.4% for profitability of 10.6%. The problem is it's not really an apples to apples comparison to the real live practice that we just saw, because I'll give you a couple of examples. Depreciation, which is normally an expense that lives the language we use is below the line, right? So after net operating profit is in here at $73,000. So on profit of $318,000, that $73,000 would be removed from the expense line and improves the profitability by a few percentage points right away. Joy, I'm reading that right, am I not?
Absolutely, 100%.
Yeah. You know, and then there's things like an $18,000 interest expense, which again, this goes to the definition of profit that you're using, EBITDA, right? Earnings before interest, taxes, depreciation, and amortization. A lot of this interest expense could drop to the bottom line. So added to the 73 or 91, you're almost 100,000, almost a 30% pickup in your net operating income.
And Martin, there's also 44,000 of amortization sitting there as well.
There you go. So, so short time frame, limited information, short time frame to do a fully deep dive. You can still use the 5 buckets analysis, but again, you need to make sure that you're using the same baseline, which is why, yet again, the VMG AHA chart of accounts is so important, and why this practice is actually probably much more financially successful than this P&L even reflects. just simply because there's depreciation, interest, and amortization sitting in the operating expense in the expense categories, which don't need to be there. Okay, it's 10:57 Pacific, 1:57 in the East, and something 57 L points in between. This has been a super fast and fun. I love doing this kind of thing, and if it was helpful to you, I sure would love to hear about it. If it wasn't helpful to you, I'd love to hear about it too. I'd love to hear about that too. Joy, thank you so much for playing and giving us your thoughts. And I would love to do this again and just continue to have fun pulling apart P&Ls. And the more you practice, this is a muscle that needs to get exercised, and the more you practice, the more comfortable you become with your own numbers, which again is the gateway to improved financial stability, and also helps you sleep better at night, which is, I think, super important. I'll stick around. We can stick around for any questions that if anybody wants to stick around and ask questions or give feedback, happy to do that. But otherwise, we'll thank everybody for their day. Danielle, do we have any questions?
You are just getting currently a lot of thanks coming through. So people are starting to look at their own P&Ls.
That's right. Great. Thank you.
Well,
Okay.
I will say thank you, Martin. This was like you. I have great fun doing this. It's always exciting and a pleasure to banter with you about P&Ls. But I would also love to get feedback from the team as to how useful this was, from everyone, and what you could potentially be even more useful.
Yes, thank you. If we missed stuff, we'd love to hear about that.
We just got one more question, a last minute question.
All right.
How do you calculate DVM labor versus other labor?
Okay, so first place I go is to the AHA VMG chart of accounts, which has a dictionary definition. And so as not to speak out of turn, if people want to stick around for that, we can go there quickly now. I pull it up here. And this is going to be a little more difficult. Oh no, owner of veterinary
Associate veterinarian.
Associate veterinary compensation, 70/80. 70/80. Okay, so this is the gross amount of salaries, wages, bonuses, and commissions paid to employed veterinarians, including credentialed specialists with no ownership rights, gets posted to this account. That's the associate vet compensation. You then need to do an allocation for benefits, taxes, and other expenses, which isn't as clean because there isn't a bucket for non-owner, for associate veterinarian benefits versus associate veterinarian taxes. So if you want to really understand it, you need to do that allocation. This will get you the breakdown of comp will get you pretty close to an allocation of, are you of your total comp, what percent is DVM comp versus non-DVM comp, and then you can allocate that percentage to the benefits and taxes. That makes sense. So I feel like I butchered that a little bit.
You said got it. So.
All right, perfect.
Awesome. All right.
Top of the hour.
Yep.
We're good. Thank you, everybody. This was fun.
Thank you.